Hello, my name is Tony Helton, and I'm going to discuss some tips on personal debt management for you today. Let's begin with personal credit scores. Your credit score impacts how much interest you pay when you borrow money from an institution. As you may know, the higher the score, the lower the interest rate would be. Credit risk is commonly evaluated based on models developed by Fair, Isaac & Company. We know it as your FICO score. So what is FICO Score? FICO Score is a 3-digit number summarizing a borrower's credit risk. It's used in over 90% of U.S. lending decisions. It's based on data from the 3 major credit bureaus, Experian, TransUnion, and Equifax. It's used by lenders for quick, consistent, and objective evaluation of a borrower's credit risk, so your ability to pay them back. So let's dig a little deeper into the FICO score and the ranges. So a 0 score means you have no credit rating. An 800 or plus is an excellent rating, and it demonstrates to lenders you're an exceptional borrower. 750 to 799 they consider very good, demonstrates to lenders you're a very dependable borrower. 670 to 740 is considered good. They consider that a good score. 580 to 669, considered fair. Many lenders may approve this, but some may not. And anything below 580 is considered a poor score. They consider that very risky from a borrowing perspective. So how is the FICO score calculated? It's based on payment history, about 35% of your score. The total debt that you have is about 30%. How long you've had a credit history, how much new credit you have, and what the mix of the credit is. So some of the actions that may affect your FICO score, I'll talk about how to improve them. One is timely payments. Secondly, lower the number of accounts carrying any type of balance. Also, lower the total amount owed on all your credit cards. A longer credit history is beneficial to you, and a cosigner with solid credit score also helps you. Let's also look at ways that negatively impact you. Recent and or frequent late payments aren't good. Bankruptcies, foreclosures, liens, they don't look upon that very kindly. Higher total debt balances, too many accounts. Higher credit utilization, meaning you're maximizing the credit they've given to you. Shorter credit history, or a higher number of new accounts, all will be held against you. Let's take a look at a graph that we have now where we're going to look at a mortgage of $200,000 over 30 years at a fixed rate, where I can go in a little more detail the impacts of poor scoring to you. So let's look at the graph that's on the screen now, the credit score ramifications. Along the bottom axis, you see the credit score. Left to right, you see the highest to the lowest. The solid line is current interest rates that you could be charged based on these ratings. And then the dotted line, we look at what your mortgage payment would be on a monthly basis, again, based on a $200,000 loan at a fixed rate over 30 years. Really what I want to magnify to you is the best score on the left, 3.44% would be the interest rate, or roughly $900 a month. And if you go to the far right side, when you look at the lower credit rating, the 5.03%, so 1.6% higher than the 850 score, or $1,077 a month. If you look at the difference in payment, it's almost $200 a month. Same mortgage, same length of time, yet the only difference is the credit that they've assigned to you, the rating that they've assigned to you as it relates to your credit score. So if I can emphasize, the better the credit rating, the better the credit score you have, the lower the interest you'll pay, which ultimately means lower dollars that you'll end up paying these lenders. So let's look at types of credit. So why would they lend you money? Look at your mortgage, an automobile loan. I think most of you are familiar with student loans. Finance companies can lend you money. Certainly we know about credit cards. And with credit cards, there are retail accounts as well. So I'm always asked, should I consolidate my debt or not? Well, let's look at the pros of that. One is you should always consolidate if you get a lower interest rate, potentially lower your monthly payments. And certainly that provides the convenience of a single payment versus multiple payments. The cons, you're going to be charged a fee for this, some type of service fee, potentially a longer payoff period, which leads to greater total interest cost over extended term of the loan. Previously unsecured debts may not require collateral. You may have to put your house up or your auto up. And the biggest point here, there may be more room in your budget for additional debt. This is where I'll caution you. When you free up more capacity, meaning you've paid off your credit cards by consolidating the debt, that gives you an opportunity for a lower payment, which gives you more cash available to save, which also leaves you the opportunity to borrow more on those open credit cards account. That's where we get into trouble. My recommendation is to pay off that loan, that consolidation loan, and not use your credit cards. You're building the credit during that period of time as well. So let's look at another visual. It's called debt consolidation. So in this example, if you look on the left-hand side, I've put a couple different scenarios in here. One, education with a balance of $180,000, a 10-year term or 120 months at 8% would leave us with a monthly payment of $2,200. Total interest payment over those 10 years would be $82,000. Auto at $40,000 over 4 years. Credit card consolidated at $20,000 over 4 years. I put a higher interest rate in here because I know the interest rates on credit cards are all over at 20%. And in total, you could see that the debt here is $240,000. The monthly payment is $3,700, and the total interest over those different periods would equate to $95,000. So now let's look at consolidating the debt, and if you move further down on the slide, and well, let's say we want to keep the same monthly payment. What does that mean for us? So you have the same $240,000 balance. We've consolidated and said, well, let's go out 7 years or 84 months on this term at 8% interest, which is very good on a consolidation. We still have the exact same monthly payment of $3,700, but look at the difference on the interest. If $74,000 would be your total interest compared to just above that, if we were going with those different terms of $95,000, you'd save $21,000 in interest over those 7 years. I'm sure we can do a lot more with those $21,000. But let's go down one step further and say you wanted to lower your monthly payment. Same $240,000 balance. The term now is 10 years at 120 months, same 8% interest, but your monthly payment goes from $3,700 down to $2,900. So you get the benefit of that $800 a month of liquid cash. But look what happens on your interest. So you go to $110,000 of interest. Now if you compare that to the original debt that we have of $95,000, you're paying $15,000 more in interest in that scenario. Or if you compare it to the same monthly payment, you're paying $36,000 more of total interest. And what I would say here is if you're looking to consolidate to free up cash flow, then look for the lower payments. If you're looking ultimately to save on your interest, I would look for a same monthly payment but consolidate that debt at a lower interest rate. So I know we covered a lot there in a short period of time, so let's just take a moment to recap. So to establish solid credit scores, a reminder, keep low number of open accounts, keep your balances on the revolving credit low or pay off completely each month, make all payments timely. I can't emphasize that enough. If you make them timely, that bodes well with all the credit agencies. And if needed, add a cosigner. To improve weak credit scores, consolidate your loans, close unnecessary accounts, utilize established credit instead of opening any new accounts. I hope that was helpful to you. Thank you, and have a great day.